Definitely, the shifts in Fed view is the biggest driver for policy, for interest rate, for FX, and that is having a knock-on effect. So we do expect Singapore banks to continue to do well because if I look at banking system liquidity, Singapore banking system liquidity is pretty good, and that continues to be the case. And the way banks are returning capital, that continues to be the key driver of the bank stocks. Some of the emerging ASEAN banks, we do not see similar liquidity dynamics that we see in Singapore, and hence we see a degree of mixed performance in those banks. Now, over, let's say, next 6 to 12 months, Fed expectation will not move in a straight line, right? JPMorgan house view is for 2 rate cuts starting, let's say, middle of the year, or continuing rather. Now, as that expectation of rate cuts changes, if we expect more rate cuts, it will be more beneficial to most of the emerging ASEAN and emerging markets generally, and that will benefit the bank stocks and vice versa. So those are the, plus then what happens to the domestic policy making priority? Is it more growth focused? Is it more FX focused? And we are starting to see that shift. As you pointed out, we are getting a bit of rate cuts. We had MAS adjusted the policy. We had a rate cut from BSP. We had a rate cut from Indonesia. So we are getting a lot of the policy responses, and that is beneficial for the domestic liquidity.
Now, you mentioned something about liquidity being a bit deeper in Singapore versus that of the emerging market banks in Southeast Asia, which might mean their fates or fortunes or ability to withstand this might be different. How big a liquidity difference are we talking about when you compare Singapore to some of its peers in Southeast Asia, given that Singapore is a more developed economy than many of its other neighbors here?
Yes, so when I say liquidity, think of it more as a financial conditions. Okay. Singapore is attracting a lot of capital flows, and that continues. Wealth management is an important part of that. The interest rate differential, as we know, Singapore manages monetary policy via FX. So all of those benefits the flows in Singapore. Current account surplus also helps, and all of these benefits are getting entrenched. But what is very important is the banks in Singapore have very deep moats around deposit franchise, and hence whatever be the liquidity situation, their cost of fund does not go up as much. But the asset yields continue to move up with higher rates, and as we expect higher for longer in US, that reflects in Singapore. And that differential allows them to generate a lot of profits and distribute the profits, which is not necessarily the case in most of emerging ASEAN and emerging markets, emerging Asia, let's say broadly.
I see.